Guys, welcome to my channel. I hope you guys are doing well. In today's video, we will learn about the share warrants, and the topics that I will be covering is the meaning and the important terms or the terminologies that are related with the share warrants, and we are going to understand everything with the help of the example. Further, we are going to discuss about the types of warrants and very importantly the valuation of share warrants. Then we are going to discuss about how are stock warrants or share warrants being taxed, and finally the merits and demerits of share warrants. So let's get started. First of all, let's understand the meaning of the warrants. Warrants are being issued by the companies and it entitles the purchaser to buy fixed number of ordinary shares at a particular price during a specified period of time. Here are certain terms that you need to understand: that fixed number of shares a person can buy under a warrant. Okay. At a particular price, the price is fixed beforehand and during a specified time. A certain period is given to you and within that period you can exercise any time that warrant. Alright. Over here you need to understand that a warrant gives purchaser the right to exercise his warrant, right? And there is no obligation to exercise. You have an option to exercise or not, right? Further, it is given that the share warrant is a negotiable instrument that gives the owner the ownership merely by delivery of the warrant. Alright, and each warrant has different coupons that is being given by the company. Okay, whenever the company declares dividend on the warrants, so whosoever possesses the warrant will be given the dividend. Here are important terms that you need to understand warrants in detail, right? First is the exercise price. Now, what is the exercise price? This is the price that is fixed beforehand and at which shares can be acquired in future, right? Exercise price is the price at which shares can be acquired in future. We'll understand this with the help of the example, don't worry, right? Then is your exercise ratio. Now, what is this ratio? Every company issues warrants in certain ratio. Say 1:2 is the ratio. Now, what does this mean? This means for every one warrant, the purchaser can buy 2 shares. Alright. Next important term is the expirational date. What is that? This is the period within which you can exercise your warrant. Generally, this period is from 5 to 10 years and it can be perpetual also. That varies from companies to companies. That means during which you can exercise your warrant. Next important term is detachability. Warrants oftenly come with the term whether it is detachable or not. Now, what is the meaning of detachability? For example, say if I hold shares, 1000 shares in a company, along with that I have 50 warrants of that company. If this is detachable, the warrant is detachable, that means I can sell 50 warrants separately in the stock market, right? And continue to hold my 1000 shares. However, if this is non-detachable, I cannot sell my warrants separately in the stock market. I will have to sell my shares also along with this. So, whenever my shares are detachable, that means I can sell them separately in the stock market. Next is the right. As you know that all the shares give you certain rights like right to dividend, right, and right to vote. Unless the warrant holders becomes the shareholder of the company, they do not have any right to dividend or any right to vote. Clear? And the last important term is the warrant premium. Now this is the initial amount that needs to be paid to acquire the warrant. Initial amount needs to be paid to acquire the warrants. I hope I have cleared you the important terms. We are going to understand this with the help of the example. Don't worry, right? And still, if you have any query, please comment in the comment section. I will reply you. I've taken an example over here of XYZ Limited. Now, it is issuing one share for one warrant, and what is it? Exercise price is $50 per share, and the expiration period is 5 years. That means within 5 years, any time the warrant holder can exercise his warrant. So one of the investor is there. What he does, he purchases 100 share warrants of the same company at 10 per warrant. Okay, so what is the total amount that is he paying? This is your warrant premium. Initially he is paying how much? 100, that is share, into what is the cost? $10. This comes out to be $1,000. This is the premium that he has paid to acquire the warrants. Okay, so what happens is after the third year, the market price of XYZ stock reaches to $80. Right? In the market, we are getting the shares of $80. However, John has already acquired the right for the warrants at the rate, what was the exercise price? $50. So if I can buy the same amount of shares at the rate $50, why would I go to the stock market and purchase it at the higher rate? Right? Thus, John will exercise his warrant and purchase it at the rate that is $50. I hope I have cleared you. Right. Let's move further. There are two types of stock warrants. First is the call and second one is the put. The difference between the two is only that call warrants gives you the right to buy the stock, whereas put warrants gives you right to sell this stock. Right? And what will be the profitability in call? When the market prices will be higher than that of the exercise price. How? Let's understand this with the help of the example. If the strike price over here or the exercise price is 1100, right? And supposedly you're getting the same share in the market for 1500. Would you buy it from the market or will you exercise your warrant at 1100? Exercise the warrant. Right? And taking the same example, if the exercise price is 1100 and in the stock market the share price is 800, will you exercise your warrant? No, now you will not exercise your warrant. Because you can go directly to the stock market and buy the shares at a lower prices. Have you understood? Okay. And for the put warrants, what is profitable? When the exercise price is more than the market value. How? Let's understand this with the help of the example again. Taking the same example, the exercise price is 1100. And in the market, I can sell my shares at 1500. What will I do? It is better to go in the market and sell the share instead of exercising the warrant at lower price, because I'm getting the higher prices over here, and as a seller I want more money, more prices for the share. Okay. Next is the valuation of the share warrants. For that, there are two major parts that you need to understand. First is the theoretical value of the warrant, and next is the market value of the warrant. In the theoretical value, the amount for which the warrants can be expected to be sold in the market is your theoretical value. We'll understand this with the help of the example, don't worry. Further, it is given if the share price is less than the exercise price. Market price is less than the exercise price. Warrants value becomes 0. How come? In the previous question, in the previous example, we saw that if exercise price is 1100, right? And in the market, I am getting the same share of 800. Will I exercise my warrant? I will not exercise my warrant. And therefore, the value of warrant becomes 0 because I am not exercising it, right? Okay, now what is the formula for computing the theoretical value? It is the market value minus the exercise price into number of shares. Okay. And next is the market value of the warrant. What is the market value? That is prevailing in the stock market, the current prices, right? And it is said that the market value of the warrant is generally higher than the theoretical value of the warrants. Alright. It is further observed that as the expiration dates come nearer, this market value tries to become equal to the theoretical value. Right? And the difference between the market value and the theoretical value gives you the warrant premium. Clear? Okay, let's take an example over here. ABC Limited is there and it is giving you the exercise price that is 100 per share, right? Besides that, it is giving the holder of the warrants to purchase 2 shares per warrant and the current market price is 112.5 per share. We are supposed to calculate the theoretical value. What was the formula for calculating the theoretical value? Market price minus exercise price into number of shares. Now here what is the market price? 112.5 minus exercise price, that was 100, into number of shares, that is 2. This comes out to be rupees 25 is my theoretical value. And from the same question, if I have to compute the share premium, what is the formula for the same? Market price, that is 112.5 minus theoretical value, that is 25. This comes out to be rupees 87.5. This is the share premium. This is the warrant premium. This is the warrant premium. Alright. Now here is the diagrammatical representation of the market value of the warrants. Over here, if this is the exercise price and here is my theoretical value. And this line represents my market value. So the difference between the two is my share warrant premium. Right? You can see as the share prices increases, the premium is also increasing. Next very important topic over here is how are stock warrants being taxed. First case is when the stock warrant is being purchased. In this case, no taxes are to be paid either by the company or by the holder. Right? Next case is when the subscription is forfeited. For example, if the warrant holder did not exercise his right to purchase the share, then what happens is he can claim the capital loss out of it. Right? And then when the warrants are converted into shares, once the warrants are being converted into share by the warrant holders, even if he is holding the warrants, he is supposed to pay the capital gain. How come? he has to pay the taxes on capital gains. Why? Capital gains is equal to market price of the share minus exercise price. Whatever is the difference is your capital gain, and you have to pay the taxes on the same. Last is when the warrants are being sold. So when the warrants are being sold, any capital gain or losses are there, then it attracts the tax liability for the same. Last topic for the day is the merits of the warrants. Okay, so we can see that investors enable to assess the shares without investing in the shares right now. So there is a huge time gap being given in the warrants, and the investors can easily sit and analyze their shares before investing a huge amount in the shares. Then it is being easily transferable by mere delivery. Banks also accept warrant as a security for the loan. The company may provide the dividend in the future, and whosoever is possessing the warrant will be entitled for the dividend. And here are certain demerits of the warrants. First is, a bearer of the warrant is not the member of the company unless he exercises his right to become the shareholders by buying the shares. Then it is very risky because that can be lost, because these are easily transferable. The company should be careful by printing and keeping the share warrants in the safe custody. The share warrants, they attract heavy stamp duty. And last is, the prior approval of the central government is initial for the companies to issue the share warrants. So that is it for today, guys. I hope you've enjoyed and learned something. If yes, then please subscribe to my channel. Thank you and have a nice day.